All right, hello everybody, and welcome to the April Lerner Group monthly discussion meeting. I'm joined by JR Gondeck and David Sokolovsky. And as we look at what's been going on in the markets and the economy the last month, I think the big trend that people have been talking about is, are we seeing a potential recession on the horizon? What are our thoughts about it? And really, where do we see markets sort of moving? And as we talk about the economy, Jared, if you could pick up on this, I think one of the big ideas is if we go from a booming economy to an okay economy, is that okay?
Well, you look, Michael, I think that's the goal of the Fed, is to kind of talk about a soft landing. But if you kind of start the conversation and look at mortgage rates and what's happened year to date is very interesting, to say the least. On will it slow things down? Will it cause the recession? And when you look at the graph of 30-year mortgages, it's very telling. I mean, look at this graph. This is the last year of 30-year mortgage rates, where you look up until January, they were hovering plus or minus 3%. And all of a sudden, you're up over 2% on 30-year mortgages year to date. So if you think about the impact from the price of homes up and a higher interest rate on mortgages, it's really could have an impact to slow the economy and cause the recession that is an overhang to the market. And you can see that with that such. So David, when you think about that issue with housing prices up and interest rates, is that really going to cause the housing market to grind to a halt?
Certainly, the idea is to slow down the excessive housing demand that we've seen in the rapid increase in prices. I don't think it's going to come to a grinding halt. And there's some data points to suggest that, if you kind of take a look back to where we were in terms of interest rates, that graph definitely showed the rapid increase that we've seen in the last couple months. But that really just takes us back to where we were in 2018, 2019, right? So if you think about mortgage rates back then, they were very, very similar to where they are today. The difference that you see over the last couple of years is, like you mentioned, housing prices in general have increased. So that also adds to the cost of the mortgage. But one thing that's also increased over the last couple of years has been just overall employment income and just general earnings for everybody who participates in the economy. So if you think about the rate of wage increases, it was about 3% in 18, 3% in 19, 4%, and then 5%, 20 and 21. So you basically have a cumulative, nearly 15, 20% increase in wages, and that's outside of what we've seen over the last year. So last year we saw some very major increases where minimum wage was increased from maybe $7 or $8 in some areas to $15, and so there's a lot more additional capital, I would say, to be able to afford some of the increased housing prices. But the idea with increasing rates is that it's ultimately going to stop that rapid rise of housing prices. So whereas kind of looking back 2 months ago, if you were looking at $1 million mortgage at 3%, and now you're looking at a 5% mortgage, now to keep the same payment, that might be, an $800,000 mortgage. So it's less house than you could afford in the past. But the difference is that you're able to see the increases in incomes that'll support that difference. And I think in many cases, that's more than what you saw in terms of house price increases.
So let's talk about that a little more, David. So let's put some numbers behind it. So if housing or mortgage rates have gone from 3 to 5, what increase in income do I need to sustain that? I mean, how big of an increase?
Yeah, so if you take a family, let's say it's $300,000 of total income, and you're looking to get a mortgage for $1 million, that increases about $1,000 a month. So if you take that same $300,000 family and they got a 5% increase last year, forget about the couple years past that we talked about, right? But just last year, that 5% basically gets you to where you need to be able to afford that new mortgage.
So as you summarize that, it feels like despite the fact that mortgage rates are up a lot so far this year, taking that back to where we were in 2018, and incomes are up dramatically over the last 4 years, that there is a period, Michael, as you started, can the Fed create that soft landing? It sure feels like they could, given that incomes have risen dramatically despite the higher rates. So it's something to watch for on the housing activity, because it feels like it is slowing down a little bit, but that's a good thing, not a bad thing longer term.
Right, and you just mentioned interest rates, Jared. I think it's also important that to sort of talk about the fact that as the Fed does raise interest rates, it doesn't have a direct one-to-one correlation with the mortgage rate market. And so where we are right now, this between 5.5%, as we said before, sort of the same levels that we were pre-pandemic. But again, it's really not the same as if the Fed raises a percent, that mortgage rates are going to go from, say, 5.5 to 6.5. So sort of the range we are right now is probably where we're likely going to stay moving forward for a little bit.
And when you touch on the Fed, Michael, I mean, they've really kind of talked the market down on inflation in a lot of ways. I mean, it's been a tough period because the Fed is catching up. A year ago, they should have started to cut the balance sheet and slowly raise rates, but they didn't. They just stopped printing money a little over a month ago. And now they're talking tough to the markets. The markets are now believing the higher short-term rates are ahead. But to your point, the intermediate and long-term rates, mortgage rates as an example, have already priced in a lot of those future rate hikes overall. So it's going to be interesting to see how the markets adjust. And even Powell today during some of his conversation talking about inflation, that maybe the month of March was the peak. And it's too early for all of us to tell, including the Fed, but there is a lot of reason to believe that inflation may have peaked last month. And as we think about that, David, maybe what are some of the examples or thoughts around inflation of maybe easing in the months ahead?
Yeah, and I think it's important when you think about inflation there's two ways to look at it. There's the year over year change, so kind of what you saw a year ago today, and then the month over month change. I think if you look at year over year, it's easy to see that basically everything has gone up, right? Whether it's used car prices, the cost of groceries, the cost of fuel, etc. But if you start taking a look at it from a month to month basis and really rewinding to the start of this year, we really haven't seen that much inflation in a lot of things that we saw last year. So for example, if you were to take a look at used car prices, that's one example. They shot up wildly last year, and then throughout this year, they've kind of been tempering and in some cases coming back down. You've also seen the price of fuel and gas, right? So as you saw the increase happen very early March, that number obviously jumped, but then in the last couple of weeks, we've seen prices ease a little bit. So we are seeing some slowing of inflation, and maybe those are the same data points that Chairman of the Federal Reserve has pointed out as well. But as we look ahead, where are the areas that we see continued inflation or maybe even stronger inflation? So one area would be travel. So if you look at what travel looked like for the last couple of years, you can see that basically, here we go. You can see that, dropped significantly and basically ground to a halt at the start of the pandemic. And then over the last couple of months, it's continued to recover. It slowed again towards the end of last year because of the Omicron surge, and it's bounced back, to hover around 2 million travelers, which is really where the peak was a couple years ago. So what you're seeing now is air travel is at pre-pandemic levels, but the difference is, again, the price. The price is much higher. If you look at a ticket from Chicago to anywhere where that ticket may have been $350 to go anywhere, let's say on the East Coast, that ticket's now probably $500 or $600. And even from a month ago, that ticket has gone up a little bit and probably will continue to increase. And I think the reason for that is you see that this is the conversation that we've had over the last years. If you think about all the different opportunities you have to spend money, money that you've earned over the last couple of years, really, during the pandemic, it was improving your home office, working on housing projects and things that you couldn't do, right? You couldn't go out to eat at a restaurant, and you really couldn't travel for the most part. So as that becomes available, those would be areas that probably see an elevated level of inflation because of all the demand, all the pent up demand is going to go in that direction. But if you kind of fast forward another year and a half, that's where you're going to see some balance where somebody may need to do a housing project and somebody else may decide to travel. You now have the ability to kind of choose where you spend your money.
You also have a supply of both things there too, so you're not going to have to wait for those types of events to happen.
Well, Michael, as you think about what David's saying too, like we've been talking about the pandemic spending and trends. As we pivot and things are open and the travel numbers are open, if we're traveling, what else aren't we doing, right? And what is some of the stuff that's ending and maybe things and thoughts around that?
Yeah, so things that are going to be ending, as we were saying, during the pandemic, you improved your home office. Now we're going back to our actual offices. So you're going to have people are done with a lot of the virtual meetings aside from this. And people are looking to just get back to those live experiences. Instead of people want to go see that concert in person instead of watching that concert on some streaming service. And as we see those types of changes, we're seeing more people get more involved with some of their other local economies. If you're going back to work and you need to go start bringing clothes back to the dry cleaner, you've got that business you're supporting. You've got more business lunches, more business travel, or in the hotel space as well. So it's just a different way that people are able to support now their other local sort of smaller economies.
Well, you look at one of the trends that we hope ends this year is the pandemic trend of getting zero interest on your checking and savings account, right? And as the Fed looks to and has raised rates already, but as we all know, it's kind of like oil prices and gas prices, there's a lag. So I joke, I didn't get my email from my bank when the Fed raised rates last month, and I can't imagine many others did either. So having said that, hopefully that trend of zero interest ends this year. But when you look at loan demand and other things from an investment opportunity, the financial institutions, regional banks are fairly compelling because as things have opened up and money's going differently, companies are demanding and borrowing and growing in those areas as well. And the banks are more profitable because they're not paying us yet overall and catching up on that trend. So it's something to watch for as well.
And regional banks have also been shielded from a lot of what you've seen in the global markets, right? So they don't have as much exposure to potentially slowing M&A activity. They're not as exposed to the SPAC boom and bust, and they also don't have the exposure to overseas, which has impacted a lot of the larger institutions.
When you go back to the Fed, as we talked about a little bit ago, Michael, is when you look at the potential change of the Fed policy, so that they were falling behind and now trying to catch up and really move back to not a tight monetary policy, but they want to get to neutral. And neutral meaning that short-term rates are about in line with inflation. And I think as we've analyzed and thought through the last 6 to 8 weeks of all the volatility in the markets and trying to digest, are we at peak inflation or what's ahead? As we think a year out, it seems likely to us that inflation could be back down to that 2 to 3% range by next summer. So then the question is, if that's the case and inflation continues to moderate, where should intermediate and long-term rates be given that scenario? So how do we think about that, Michael?
So, based off what you said, intermediate and long-term rates, probably would be around where they are right now. And we're starting to see companies issue corporate debt and where you can actually get a 5% coupon. And it's really at this point in time, for the first time in several years, call it 4 or 5 years, where you've been able to say, yeah, bond market's actually pretty compelling. You've got the safety of the principal, you've got a higher income stream that, is there a lot of downside with some of these companies? And from that perspective, it just really makes some more sense. So the question I think also is, as you're looking at these companies, even if they do have to increase the rate that they're paying on their debt, when you look at it, just we're talking about with the mortgage affordability, it's not as though the extra interest payments for them are really damaging their bottom line. It's sort of a really sort of small percentage based on sort of the revenues that they're bringing in. So again, it just makes it a little bit more difficult for a business to stay profitable, but it does keep them sort of moving with markets and sort of keeping up with where rates are going to be.
And with that, David, as we kind of put all this together from a company perspective and maybe turn a little bit toward, let's say, wholesale inflation and retail inflation, or in this case, what's going to be the impact of higher interest rates on borrowing for companies as well, and kind of piecing that together. Because when you looked at wholesale prices that came out a number of weeks ago, you're still at 15% increase, whereas X kind of food and energy retail or consumer prices were much more in line for 3.5%. So how do those two kind of fit together? And is it a concern for the slowdown, or is there a reason for a little bit of optimism there?
Yeah, well, with producer prices, it's really the input, right, that goes into what the ultimate product that you sell is. But if you're looking at it from the retail side, whether that's input going into a t-shirt, really the cost of the material is typically not the biggest part, right? It's really the retailer markup. And the same thing that you're seeing with a lot of these, for example, retail stores, they haven't passed along inflation in the same way that we've seen, in other industries. Certainly, you've seen it in food, but a small increase in prices for them would more than take care of a lot of the increased debt burden that Michael mentioned, and also just keeping up in terms of growing their earnings as well. So I realize that feeds back into the inflation loop, but overall, it's still fairly optimistic because, again, the rise in interest rates and companies issuing new debt, when you look at what that impact might be, it could be, to put it into perspective, 1 or 2% of their total profitability. So having 1% less profit, sure, it hurts your multiple and may hurt your projections for the future a little bit, but generally it's not a significant impact, and still opportunity, especially as you look at the retail.
And one thing that may come back too that's ended are sales, right? You're not getting a 20% sale. When you go to buy a car, there's no discount to MSRP. But as we look ahead, you're going to see sales pick up or incentives to pick up to create behaviors. Again, as we try to normalize, as you talked about, David, if we've all been kind of rushing to do the same thing because it's all we can do, now we're all rushing to travel and experience. Over the next year, you're going to start to see that normalize. So one trend we expect to see are sales to incentivize people to do behaviors that others aren't. That just has kind of faded away over the last 2 years.
Sure. And as so we start looking ahead and we say, all right, say we've reached peak inflation, but we are essentially resetting the baseline of where prices are going to be. And it still may take some time, even if we're at peak inflation, to get back down to that sort of 2-3%. So from that perspective, it's, where are people really going to be spending their dollars? And I think one thing that's been interesting to see is just sort of how the areas between, say, talking about the consumers and on the retail side, how they've been spending on staples versus discretionary items. If we look at just some of the returns of those types of indices, or ETFs, I should say, overall over the last year, you see that both the consumer discretionary and consumer staples ETFs have had positive returns. But when you go back to where we were in November, you saw this huge shift where you started to see consumer staples and more value stocks start to really outperform. And within higher areas or higher levels of inflation, those are really just where you're able to see people start spending their dollars. And these are the types of trends that we've been able to capitalize on as we've looked for more of the value names, knowing that there was going to be some volatility coming into this year.
And as you think about that, Michael, it's interesting to see that shift that we've been talking about the last number of months. As we began the conversation of the recession concern, some people might think that you're rushing into staples because of the concern of a slowdown, or maybe inflation eating the purchasing power away from consumers, ultimately causing that slowdown, and you want to be safe with your investments. David, as we think about the inflation concern on people, is it going to eat away and we should be more conservative, or is there maybe some optimism or some view there as well?
Yeah, I wouldn't rush to empty out the shelves for toilet paper just yet. I think we had enough of that in 2020. But what you're basically getting at is, it's just really the expectations for growth, right? Because stock prices look ahead. They look ahead towards new earnings and earnings growth. And so I don't think it necessarily indicates that people are rushing to stock up on consumer staples, as much as it's saying that on the consumer discretionary side, where, again, when we talk about inflation, if your housing cost is increased, potentially the price of a new or used car has gone up, food, gas, etc. So everything, again, from last year, not necessarily from earlier this year, but then the expectation is, where would you be cutting back, right? And so you'd be cutting back. We're likely not going to be skipping on toothpaste and toilet paper. We'd likely be, maybe not buying that extra T-shirt from a sports retailer.
And the thing with the inflation too that we're watching for is savings rates. So we're still hovering around a 7% savings rate. And even though the price of food, energy, and everything is up over the last year or so, that savings rate is a nice buffer that is out there. Because so far, despite the concern of a lot of this, it hasn't shown in the overall data yet. And we think the savings rate will be that buffer, so that if inflation does moderate in the months ahead, as we we potentially expect as incomes continue to rise and rebuild, that'll help to rebuild the savings if consumers draw that down short term as well. So it's something to watch for.
And that's the first place that I think it makes sense to look. So you kind of mentioned sales, JR. So when the economy is really accelerating, you see sales disappear first, then you see prices get to normal levels, and then you see price increases. On the other way, you start to see sales first, then challenges with the economy. So I would say the same thing here is if you're seeing that sales rate starting to slow down, it's showing that the inflation is eating away. But if inflation does temper, and like we talked about some of the pricing increases or income increases that we saw earlier this year, whether it's Social Security or raises that went into effect on the first of the year, that should help catch up and rebuild. And that's going to be a very important trend to watch for just the health of the overall consumer, because the consumer does represent a very large portion of our economy, about 2/3. So that's going to be very important.
So as we turn now maybe to some planning discussion, the month of April is probably, once we get all the data, is going to be all-time record amount of revenue collected by the IRS and the government from taxes from last year. And as we look to 2022, Michael, I mean, do you expect taxes and income to be less, or how do we think about income and taxes? Maybe some planning thoughts around that.
Sure. So in all likelihood, taxes and income are going to be at similar levels, or if not higher than where we were last year. And one thing I want to say is, we've had some good returns the past few years, and it's okay, to use your portfolio to pay taxes. When you look back at the last few years, you go back to 2020, that's when the government said you did not need to take a minimum distribution from IRA accounts. So when you look at 2021, not only did you have the appreciation from 2020 and 2021, but you also had that higher amount that you had to take a distribution on from the percentage perspective. So that's what also helped, or I guess I should say help, but contributed to higher tax rates. So one thing that we're doing when we're looking at our financial plans with families we work with is, these plans account for taxes being paid out from the portfolios. So that is just, again, one thing that we want to say is, talk to us when you do have these types of questions and these types of concerns. And it's just another way that we can sort of help get through tax time, more efficiently for you. And again, now that tax time is done, that we are able to, now is probably a good time again to review the plans and sort of make some adjustments and make sure that if there are any changes that you would like to make, that we are accounting for those properly, so that again, that when we look at these plans and look at the portfolios, that they are still meeting whatever your goals may be.
And looking ahead, I think one thing that we've mentioned a number of different times is you can use required minimum distributions to make estimated payments or direct payments to the government, but this is also an opportunity to kind of plan and think ahead, right? So once you've done your taxes and you saw what your income was, likely for many people it was higher this year, or last year. But as you move into the years ahead, at some point there's opportunities that present themselves. So if your income changes or you're in between jobs, it might be a good chance to take advantage of converting an IRA to a Roth. There's a number of different planning opportunities that your taxes give you kind of a baseline for in terms of planning, but you can start being a little bit more proactive in terms of, as you're looking out ahead, to start making financial decisions that down the road won't create a very large tax burden. And those are details that we can go into with people on their individual needs.
As we conclude, looking early into earnings season so far, the results have been pretty good. There are certain industries that we've talked about that as we've reopened aren't doing as well, and there's others that are booming and continue to do very well. And the overall uncertainty between the Fed raising rates and is inflation peaked already in March or ahead? These are things that we're watching for to make adjustments, but nonetheless, we continue to maintain a larger than normal amount of cash given the uncertainty. But as we talked about earlier, it's the first time in many years that the bond market is fairly compelling, where you can lock in reasonable rates of return to put some of the cash to work safely, in our view, and if inflation moderates pretty attractively, intermediate and long term. So with that, we want to thank you for listening. We look forward to touching base next month.
Thank you.
Thank you.